All right, so the world's most powerful central bank think tank, the one that oversees $43 trillion in institutional assets, just went on record and named three specific blockchains as the future rails of global finance. And yeah, XRP is one of them. Meanwhile, smart money is loading up while retail panics. You're going to want to hear this. OMFIF, the official Monetary and Financial Institutions Forum, just published a landmark report naming Hedera, Stellar, and XRP Ledger as viable infrastructure for the global financial system. This is not some random crypto influencer. This is the think tank that advises the Bank of England, the ECB, the Federal Reserve, and the IMF. Okay, so here's where it gets really interesting. That $43 trillion number everyone is throwing around, it is not a prediction of how big tokenized assets will get. That number represents the total assets controlled by OMFIF's network of central banks, sovereign wealth funds, and pension funds. These are the gatekeepers of global capital, and they just named three specific blockchains. Now here's the part nobody is talking about. The report breaks these three into distinct lanes. XRP handles the wholesale settlement layer, right? Think interbank liquidity and high-value cross-border payments. Stellar is the retail and stablecoin layer. PayPal launched PYUSD on Stellar. Visa added Stellar to its stablecoin settlement platform. And Hedera? That is the enterprise governance engine. Lloyds Banking Group just used Hedera for the UK's first tokenized real-world asset FX trades. And yeah, JP Morgan's own tokenization report explicitly names Hedera as the example for tokenized money market funds. But here's the contrarian take you need to know. The same OMFIF that published this report also found that not a single central bank surveyed actually holds digital assets. 93% have zero intention to. So this report is aspirational positioning, not adoption confirmation. The infrastructure is being built, but the money has not moved yet. Now let me shift gears here because while we are talking about institutional infrastructure, the crypto market just went through its worst single-day crash since FTX. $311 billion wiped out in one day. And one of the smartest entrepreneurs in media just told everyone what he did. So Patrick Bet-David, right? The guy who built a $350 million empire from literally being a refugee, he goes on his podcast and says, quote, "I just bought a bunch of XRP and Bitcoin yesterday." He is dollar cost averaging into the crash. Now, why does this matter? Because Bet-David is not a crypto native influencer. He is a traditional finance entrepreneur who built PHP agency from zero. His valuetainment platform is the #1 YouTube channel on entrepreneurship, and the on-chain data backs him up. During this crash, whales scooped up 520 million XRP. Wallets holding over 1 billion XRP increased their holdings from 23.35 billion to 23.49 billion. 1,389 transactions over $100,000 in a single day. That is a 4-month high. And here's the thing that really caught my eye. Unlike last year, when mega whales waited until late February to buy, this cycle they are building positions earlier. Michael Saylor's strategy bought 855 more Bitcoin right before the crash. MetaPlanet in Tokyo is now the 4th largest corporate Bitcoin holder. The pattern is clear. Smart money buys fear. Retail gets liquidated. $3 billion in liquidations. 700,000 traders wiped out. Okay, now this is the development that I think most people are sleeping on. TradeWeb, one of the largest electronic trading platforms in the world, just put U.S. Treasury benchmark closing prices on chain through Chainlink. Let me explain why this is absolutely massive. Okay, so first, you need to understand what TradeWeb actually is. This is a company that processes over $2.4 trillion in trading volume every single day. They operate electronic marketplaces for rates, credit, equities, and money markets across 85 countries. This is one of the most important pieces of financial plumbing on the planet. Now, what they just did is publish the TradeWeb FTSE US Treasury benchmark closing prices on chain through Chainlink's data link service. These are not just random data feeds. These benchmark prices are registered under EU and UK benchmark regulation and are the official closing prices for the FTSE World Government Bond Index. Chris Bruner, TradeWeb's chief product officer, said, and I quote, "Tokenization represents one of the fastest growing opportunities in our markets today." And Chainlink co-founder Sergey Nazarov called it, quote, "a strong signal that the adoption of tokenized finance is accelerating." Here is why this matters more than people realize. The U.S. Treasury market is over $24 trillion. By putting institutional-grade benchmark data on-chain, you now enable DeFi protocols to build sophisticated fixed-income products using real pricing data. Think automated collateral management. Think on-chain repo markets. Think tokenized treasury products that settle in seconds instead of days. Chainlink already secures nearly $100 billion in DeFi TVL. This is the bridge between the $24 trillion treasury market and the entire on-chain economy. And for our final story today, this one is about the structural evolution of crypto itself. Kraken Institutional just launched its first ever managed yield strategy with Bitwise Asset Management. And the implications here go way beyond just another product. So here is what is happening. Kraken, which, by the way, is now valued at $20 billion after raising $800 million from Citadel Securities, Jane Street, and Apollo, they just launched the Bitwise Custom Yield Strategy. It is a Bitcoin covered call options overlay that generates yield for institutional clients while assets stay in Kraken's qualified custody. Now, why should you care? Because this is the moment crypto exchanges stopped being just exchanges. Think about it. Kraken is now offering custody plus execution plus professionally managed strategies from third-party asset managers, all under one roof. That is literally the Goldman Sachs prime brokerage model. Gurpreet Oberoi, head of Kraken Institutional, said, quote, "We are expanding beyond custody and execution to provide clients with access to professionally managed opportunities through a single trusted venue." And here is the really clever part. Institutions that bought Bitcoin through ETFs now hold a non-yielding asset. Pension funds have return targets. Endowments have spending policies. Bitcoin pays nothing. A covered call strategy generating 12 to 18% annualized yield on Bitcoin in a 4.5% risk-free rate environment, that fundamentally changes Bitcoin from a speculative bet to an income-generating institutional asset. This is the first managed account on the platform, and Kraken has confirmed more strategies from more managers are coming. We are watching the birth of crypto prime brokerage in real time. So let me connect the dots here. Central bank think tanks are naming the rails. Smart money is buying the crash. The biggest fixed income platform on earth is putting treasury data on chain, and crypto exchanges are becoming prime brokers. This is not one headline. This is a pattern. The infrastructure for institutional crypto adoption is being built right now, and most people are too busy watching price charts to notice. The question is not if traditional finance adopts blockchain. The question is whether you position yourself before the $43 trillion starts moving. That is the game. If this kind of analysis is valuable to you, smash that subscribe button and drop a comment. Which of these 4 stories do you think has the biggest long-term impact? I genuinely want to know what you think. Until next time, stay sharp. Subscribe for institutional grade crypto analysis. Comment below, which of these 4 developments has the biggest long-term impact? Like and share if this gave you insights you could not find anywhere else.